Tariff headlines front and center today as President Trump threatens Apple and the EU, which comes after market pressures this week driven by, in part, a spike in Treasury yields. Joining us now is Torsten Slok, Apollo Global Management chief economist, which is actually the tariff threats today are leading to the buying of Treasuries, taking some of the heat off those yields. But in general, how concerned are you about it?
Well, of course, there are now two competing narratives. For the last few days, we've been talking about the fiscal situation, the upward pressure on long rates because of fiscal, and of course, the upward pressure on front-end rates because of tariffs. And it looks like now we'll be talking about tariffs again, not only, of course, what it means for inflation and rates, but also what the implications will be for growth.
Where are you on what it means for inflation and rates?
So the
Both
yield
higher?
budget, yeah, absolutely. So this is essentially stagflation. By definition, tariffs means higher inflation, and it means lower growth. If you look at consensus expectations for the last several weeks, have evolved so that there are higher inflations, roughly 1 percentage point over the next 9 months, and growth will also be, in round numbers, be roughly 1 percentage point lower over the next 9 months. So it clearly is a very significant divergence in terms of inflation going up and growth expectations and earnings expectations going down.
But the equity market has been pretty resilient.
I know it's very surprising. If you look at the earnings revisions ratio, that looks at what is the number of downward revisions divided by what is the number of upward revisions. That has shown a fairly significant decline in the last 2 months. That means that more and more companies are revising earnings expectations down relative to earnings expectations up. And that's on its own also telling you that we should expect to see a continuation of this environment we've had through this earnings season, where we have seen more downward pressure on earnings, both from Ford Motor Company reporting, of course, earnings hit from tariffs, and also, of course, Apple and a number of other industries. So the bottom line is we should expect to see earnings weaken over the coming months.
Do you expect this to make its way to the labor market? I mean, we've gotten some layoff announcements, but they've been very surgical.
That's right. And the labor market is also very important, driven by the fact that immigration is now, of course, much more impacted by the fact that the labor force is not growing to the same degree that it was before. So that's right. You have had jobless claims much better than really what most people expected. So the question is, what are companies doing? And the answer is probably companies are probably hoarding labor and saying we're trying to deal with the uncertainty from tariffs, deal with the general level of uncertainty. And because of that, you have not quite yet seen the layoffs. But the consensus does expect the unemployment rate over the next 6 months to go up by 0.5 percentage point. We should expect to see that come.
You had a nice chart today looking at tech hiring and how it relates to rates and how that all leads to what you called an AI bubble. Did you mean that?
I do mean that. I still think AI valuations are very, very high. And I do think it's very, very notable that here we have had, for the last several years, when the Fed began to raise interest rates, hiring in the Magnificent Seven basically stalled. And you ask the question, well, why did that stall? Because the discount rate, interest rates going up, is, of course, not good for companies that have earnings far out in the future. Yes, the Magnificent Seven, of course, have earnings here and now, but valuations were reflecting the expectation that earnings would be strong for a very long time. So I am quite worried still about the downside risk from interest rates now staying higher because of, which we just talked about with Sarah here, inflation being higher for longer.
When you talk about AI valuations, I mean, it's not all created equal. Alphabet trades at 16 times earnings. NVIDIA is, frankly, not that high a multiple given its growth rate. I can go on and on. I mean, so what are you talking about when you say AI valuations?
So Tesla, Apple, NVIDIA, I mean, all of them have earnings that, of course, are dramatically higher than a lot of other parts of the S&P 500. And one very important reason why earnings went up so much, of course, was that they did have solid businesses. But valuations went up a lot more simply because interest rates were zero. Now interest rates are not zero. And if you add tariffs to this and we have higher inflation and the Fed is not going to cut, the risk, of course, is that especially business models that have cash flows that are far, far out in the future, meaning growth, venture capital remains very unattractive because when you have cash flows far out in the future, they will generally not be doing well in an environment where the cost of financing is high.
No, I do get that. When you say broadly speaking AI valuations, it doesn't appear to me that you can really say that broadly about every single stock that has to do with AI.
Well, hold on, but I think most of them are exactly because interest rates were zero. That's why valuations went up so much. Yes, they are making money, but the bottom line really still here is that growth, think about it the other way, the Fed is trying to slow the economy down. That's the reason why interest rates are high. So we should expect growth to not perform well. And tech is the definition of growth. So that's why the headwind to growth from higher rates should continue.
Right. I also think that, your stagflation call, it's not necessarily consensus yet, and we're not seeing it yet. I mean, the Atlanta Fed is still tracking for what, 2.5% growth for the second quarter, and we haven't seen inflation.
Understood, but so many companies are saying that they can't provide forward guidance. Is not a worry. So many companies during this earnings season have been saying that they were hit by tariffs. Why shouldn't we expect that to happen? Therefore, it makes sense that the earnings revision ratio is going down.
Sure, but they don't know their cost structure. But we're not seeing mass layoffs, to Carl's point. And we're not necessarily seeing a big pullback in the consumer yet, even if they're feeling gloomy and a little uncertain. So it's not necessarily predetermined yet that we're seeing stagflation.
Okay,
That's all I'm saying.
But let's just agree that there must be a lot of pressure. At least the consensus is telling us that inflation is going up. And the consensus is also telling us that growth is going down. We can have a different view from the consensus, but consensus is normally what drives the market.
But short-term inflation, not longer-term inflation, not inflation expectations, and not anything more lasting.
So in Q1, CPI was 2.7. The consensus is expected to go up to 3.5. That's far away from the Fed's 2% inflation target. So yes, I hear you. But the cloud of uncertainty hanging over business planning is, of course, the main worry here. So that's why the uncertainty that comes from tariffs, and including now today also in Europe, of course, is, of course, something that constantly is a drag on earnings expectations, and therefore should also be a drag on GDP and ultimately, to Carl's point, on the labor market.